Hey guys, welcome to Your Money Matters. This is Joanna again, and wow, the sun has been really bright these past few recordings. I'm really sorry about that. It's just the time of day I get off work, so it's really all the time I got before I do chores and all that sort of stuff. So today I really wanted to talk about, to go back to investing. I'm going to be talking about something called modern portfolio theory. So what is modern portfolio theory? I know probably most of you haven't actually heard the term before, but if you do have a retirement account, like with your employer or through a Roth IRA or a regular 401k, or like a regular IRA, you've probably encountered modern portfolio theory. Another really good example where you might have actually come into contact with it before is if you had a robo-advisor, or if you signed up through a platform like Wealthsimple, Wealthfront, Betterment, Acorns. All of those robo-advisors also allocate your portfolio, or the stocks that they invest you in, according to modern portfolio theory. And it's something that value investors don't exactly prescribe to. We don't really pay much attention to it, and there's a very good reason for that, because we do invest in a very different way with a different mindset. So what is modern portfolio theory? Well, to be really basic and simple, and there's a lot of math that does go into this, this theory goes back to the 1950s. A man wrote a book on it, and I can link some stuff down in the description if you guys are interested in researching it, but it's a pretty quick Google search to find out with the name of the guy and all the books that he has written about the subject. But basically what it is it tries to calculate risk and return on an individual's portfolio. So let's say that you try and sign up for a 401k or robo-advisor, and they'll probably give you something called a risk assessment quiz or a risk assessment allocation or something like that. That is a quiz that's trying to determine, based on your time horizon, your personality, everything like that. They'll take several factors into account by a series of questions, and then they'll assign a number from 1 to 10. If your number is between a 1 or a 5, you're generally considered to have very low risk tolerance, is what they say. And what that means is they're going to try and give you stocks that won't be fluctuating up and down in the market all the time. So stocks that are very stable, stocks that usually have low, what they call volatility. And what that means, really all that actually means, is that you're going to be investing in stuff that doesn't move around. I mean, they try and assign a bunch of different words to it, but that's basically what it means. If you have a high risk between 6 to 10, they're going to probably put you in stocks like emerging markets, foreign stocks, anything that moves around a little bit more than the S&P 500. And they will still put you in lower risk stocks as well, but they're probably going to try and put you in stuff with more volatility and, as they say, more chance for a higher return. Most young people that take this quiz are going to be lumped into a high risk tolerance category, which might not apply for everybody, which is why it's really important to know the ins and outs of what your investing style should be, like what you want to do, how much time you want to put into your stocks. And this channel, I'm really going to go over for the people who want to invest in individual stocks and want to get a higher return than the market. This channel is really going to be focused on that. It's going to be focused on growing your money as opposed to just keeping what you have. People who have millions and millions of dollars are very much more interested in lower risk allocations, meaning that if they put their money in the stock market, they don't really care about getting a 10 or 15 or 20% return. They just want to keep the money that they originally put in, which is called capital preservation. Younger people, and people who are, especially people who are older and don't have at least $1 million in their retirement fund, they're really going to want to look for growth. They're going to want to look for stocks that could potentially give them a high return. And what a lot of people get afraid of is that, according to modern portfolio theory, higher return equals higher risk. But I don't necessarily agree with that. And as Warren Buffett famously said, he says that risk only equals more risk only equals more reward, and that less risk only equals less reward, if you are not basing your decisions on knowledge and thorough investigation and really trying to find a wonderful business. So basically what he's saying is it's diversification that kind of counters ignorance in a way that if you don't understand exactly what you're investing in and what companies you want to invest in, basically, if you don't understand, like, say you put your money into Facebook, but you don't know what Facebook's ROE, what Facebook's EPS, what Facebook's numbers are, if you don't even know the basics of that, or who, well, everyone knows who the CEO is, but say you don't know, like, you haven't read the past few years of financial statements, just really basic stuff like that, you haven't read the annual shareholders note, then you are going to be less knowledgeable about where that company might be going in the future, which means that you're probably going to want to diversify. And that's really what modern portfolio, where modern portfolio comes down to, is that they try and diversify all of your stocks. So I'm going to kind of cut this short here because it's already 6 minutes, but I really just wanted to explain that we don't really focus on modern portfolio theory, and I'm probably not going to be talking about it too much, but just know that everybody uses it. If they're not a value-oriented investor, if they're not like Warren Buffett or Benjamin Graham, who's dead, Warren Buffett or Charlie Munger, which is what I meant to say, or if they aren't following people like Manesh Pabrai or Guy Spear, people like that, then they're probably going to be subscribing to some form of modern portfolio theory. And I just want to clarify that if you've got a high return, that doesn't necessarily mean that you took higher risk, because you could be investing in a company that you know a lot about, that is really wonderful business, is wonderful management, and you bought it at half of what its intrinsic value is. If you've done all of that and you put your money into 1 to 10 companies and you get a really high return, well, you didn't really risk that much because you understand the company and you bought it at an incredible price. Usually meaning a margin of safety of about 50% off of what you calculated its actual book value or intrinsic value is. So a lot of people don't do that, which is why modern portfolio theory is so popular. And not only that, but you've got the people who run mutual fund managers, the people who run mutual funds who really can't do value investing. I mean, when it comes down to it, they can't sit in cash for years and years and wait for a company to come on sale. Because I'm telling you guys, I have, since I started investing, there has not been a time in the market where it hasn't been incredibly overpriced. And I've only found one company so far in the 2 years that I've been studying this that is actually on sale. In the past 2 years, like, that's just crazy to me. So these mutual fund managers, they're not going to be sitting in cash waiting for those discounts, which means that they can't buy things on sale, meaning they can't get great returns off of just a few companies. They're going to be buying the biggest companies, and they're going to be buying ETFs or exchange traded funds. They're going to be buying the S&P 500. They're going to be buying all of these mutual funds as well that won't be able to produce high returns because they're following the broad market. But yeah, I'm just going to keep this short. I can go into more detail in later episodes, but just so that you guys know what it is and why we don't follow it. I hope to see you guys soon. Happy weekend, happy Friday, happy whatever it is. And I'll see you guys next time. Bye!